Resolved, the U.S. should abolish the capital gains tax. Contention 1 is managers. Clemens of the FI writes that startup firms attract talented managers through offering them equity. However, the capital gains tax taxes equity, reducing the incentive for these managers to join. Thus, Cherry of Princeton University writes that abolishing the capital gains tax would increase the number of managers in startups by 29%. This is really important because Chip of the ULB finds that 97% of all business failures are due to poor management. Contention 2, monetary policy. Amadeo of MIT writes that the Federal Reserve, also known as the Fed, raises or lowers interest rates every quarter through changing the money supply. When they raise interest rates, they limit the amount of money in the economy. When they lower interest rates, they inject money into the economy. An affirmative ballot leads to an increase in interest rates by increasing inflation. Kemp of the Wall Street Journal writes that abolishing the capital gains tax would unleash $5 trillion additional dollars into the economy that investors are keeping wrapped up in assets because of taxation. Duff of Crone finds that the spike in the money supply would drive up inflation. Consequently, Pope of the FOL finds that the Fed will increase interest rates in order to offset this increase in inflation. There are two reasons why raising interest rates is beneficial. First is deterring debt. Deutsche Bank explains that companies have been able to borrow money without a second thought because of the current very low interest rates. Unfortunately, this causes bankruptcy because way of pocket sense finds that debt magnifies losses, reduces revenue, and decreases incentives for better investments. That's why Olaria of West University finds that every 10% increase in company debt increases a company's bankruptcy risk by 160%. Unfortunately, Graham of Duke University finds that the majority of employees lose their jobs upon bankruptcy, and on average, all employees receive 10% less wages for the next 6 years. Second is providing relief. Rothbard of MI finds that every capitalist economy follows a boom-bust cycle of economic growth followed by periodic recessions. Thus, Zoombrack of the Wall Street Journal finds that there's a 60% chance that our next recession will come within the next 4 years. Luckily, Kirchhoff of ABC News writes that during recessions, the Fed drops interest rates to almost 0% in order to try and revive the economy. Unfortunately, G of the NPR explains that because interest rates are so low right now, the Fed can't do anything during a recession. Jameen of Time finds that the Fed single-handedly took us out of the 2008 recession by dramatically lowering the interest rate in 2009, but this was only possible because interest rates were over 5% right before the recession. Thus, raising interest rates is the only way we can survive the next recession. Contention 3, shorting the bubble. Investopedia explains that shorting is when investors believe that an asset or stock they do not own is going to decrease in value. So investors borrow the asset to sell now and pay for it in the future by rebuying it at a lower value. Shorting is good because it deflates bubbles. Bubbles are when assets are extremely overvalued. Unfortunately, all overvalued assets must eventually crash in order to return to its original value, and it is these crashes which devastate the economy. Fortunately, Haruvi of the University of Texas empirically finds that short selling decreases the chances that bubbles form because it signals to other investors that a stock is going to go down, which deters investment into overvalued stocks, preventing the formation of bubbles. Unfortunately, the capital gains tax strongly disincentivizes shorting. Dial of the University of Wyoming explains that because the capital gains tax taxes short-term gains much higher than long-term gains, investors are unwilling to short overvalued assets until the end of each year when they pay less taxes. This problematically gives bubbles much more time to grow. Thus, Dial of the University of Wyoming concludes that currently investors will only short assets at the height of large bubbles, which is too late, devastating the economy. The impact is popping the economy. Preventing the creation of severe bubbles is important because Sufia 538 reports that the last two bubbles, which both grew to an overwhelmingly massive size, each wiped out $6 trillion of wealth and triggered a recession when they popped. Thus, we are very proud to affirm.
We're going to take a little bit of prep.
All right, that was 25 minutes.
Is everybody ready? Starting now. Matt and I negate resolve. The United States should abolish the capital gains tax. We observe that now is the worst possible time to have a recession, as Desmond Lackman of U.S. News writes, today's financial market situation would appear to be very much more concerning than even the September 2008 Lehman bankruptcy. Whereas then asset price bubbles were largely confined to the U.S. housing and credit market, today asset price bubbles are global. Global equity valuations today are at lofty levels experienced only 3 times in the last 100 years. Among other things, there is a global governmental bond market bubble and troubles and housing bubbles in major economies like Canada, China, and the United Kingdom. Paul Lim of Time furthers, the price-earnings ratio of the U.S. stock market now stands at 31.3, 20% more inflated than the market's valuation in October 2007, and 10% more than at the start of the Great Depression. There are 2 ways abolishing the capital gains tax makes our current situation more precarious. Subpoint A is the stock market. Mark Lang of the National Bureau of Economic Research explains 2 reasons why cutting the capital gains tax will further inflate stock prices. First, the extent a stock's returns are expected to be taxed as capital gains, a reduction in the expected capital gains tax rate enhances the attractiveness of investments to investors. Second, to the extent a firm's stock is held by shareholders subject to capital gains tax, a reduction in the expected capital gains tax rate increases its market value. Problematically, this kickstarts a cycle of market speculation. John Hussman of HIT explains, the more investors speculate, the more they tend to become impressed by the outcomes of their own speculation, which results in self-reinforcing bubbles. Thus, cutting the capital gains tax rate would drive stock prices much higher than already record levels, risking a crash. Subpoint B is overheating the economy. Investigapedia explains an overheated economy is one that has experienced high levels of prolonged period of economic growth and activity that has led to high levels of inflation from increased consumer wealth. This sharp rise in prices causes inefficient supply allocations as producers overproduce and create excess production capacity in an attempt to capitalize on the high levels of wealth. These inefficiencies and inflation will eventually hinder the economy's growth and can often be precursors to a recession. Currently, our economy is on the verge of overheating. Jeff Cox of CNBC explains growth in 2018 will continue to be above trend. However, the current fiscal path is unsustainable. The economist quantifies the sustainable growth rate for our economy is around 2%, yet currently growth is above 3%. Moreover, in the past 3 months, the economy has created, on average, 170,000 jobs per month, yet the population of 20 to 64-year-olds will, by official projections, grow by fewer than 50,000 a month. Donna Borick of CNN furthers, faster economic growth from tax cuts when the labor market is healthy and lending is cheap could cause the economy to grow too quickly. Tax cuts are unnecessary at a time when the economy is already growing at a steady pace. The Hill corroborates, writing, the last thing the Federal Reserve now needs is to have the economy receive a sizable fiscal stimulus like what a tax cut would provide at a time when it is already close to full employment and at a time when it is already receiving strong stimulus from a combination of still very low interest rates, buoyant equity prices, and a slumping U.S. dollar. An overheating economy is problematic, as Lockman furthers, that overheating will bring inflation in its wake. That in turn is all too likely to lead to rising interest rates, which could be the trigger that bursts the asset price bubbles around the world. Fortunately, Seeking Alpha reports on February 2nd that while the U.S. economy is showing signs of overheating, those signs also led to some offsetting mechanisms like rising bond yields, a more aggressive Fed, and possibly a turn in the dollar. Moreover, because earnings growth is still good, we don't see much of a case that some kind of crash is in the status quo. For that to happen, the process of overheating must escalate in pace and scope. Thus, abolishing the capital gains tax will provide this stimulus and push the U.S. economy over the edge and into recession, thus triggering a global economic crisis.
Ready? I believe I have the first question. Yep. So you talk about how right now the government is offsetting this overheating that's happening in the economy by raising interest rates and stuff like that, right?
Yeah.
So why can't the government just do that if we see more overheating?
The problem is raising interest rates is like a really difficult thing. So when there's a little bit of overheating, the Fed can pretty easily raise interest rates. But the Fed can pretty easily raise interest rates a little bit to contract the economy just enough to slow the overheat. The problem is, when you see really aggressive overheating and the Fed tries to raise interest rates too fast, it can just force the economy into recession because it contracts the economy too much.
Wait, so you're saying that the problem with overheating is that it's going to force the Fed to raise interest rates too fast?
Actually, no, it's either it forces the Fed to raise interest rates too fast, or the Fed doesn't do that and it causes other problems. Like, we literally just outstrip the supply of the country.
If the Fed is already offsetting overheating by raising interest rates, so I'd contend that more overheating means the Fed will just raise interest rates even more.
But
so
Lockman tells you that the Fed is really likely to screw up when they do this and raise interest rates too fast, which forces the economy into recession.
So is your advocacy in today's round that overheating is problematic because it raises interest rates too fast?
No. Lockman explains there's 2 things that can happen, right? Either A, that forces the Fed to raise interest rates too fast, which contracts the economy, or B, like if the Fed doesn't do that.
What do you think is the more likely thing?
I don't know.
I would contend.
The B is the economy fails either way. The economy just overheats and fails.
So you don't know.
Is it either? No, it's not. I don't know. It fails or it fails.
But there's two ways that you link into your impacts.
Okay.
I would contend that the way that you're trying to link in is the Fed increasing interest rates too fast. Because historically, we're seeing right now the Fed raising interest rates.
Okay.
So is your advocacy that the Fed raises interest rates too fast and that is
No, our advocacy is that no matter what happens when we overheat the economy, whether or not the Fed raises interest rates or not, it will cause a recession.
Well, you can't just say
we're saying we don't know, we can't predict the future, but one of two things will happen. Both are really bad. Can I ask you a question?
Sure.
All right. On your second contention, what makes interest rates relatively high or low?
Increased inflation.
No, like what is like relative to an interest? Like what? How do you define a high interest rate or a low interest rate?
When the more the Fed limits the money in the economy, the higher the interest rate.
No. What makes an interest rate higher or low though?
Whether there's less money in the economy.
It's relative to the equilibrium point. If their equilibrium point is really low, as it is right now, then it doesn't matter how high the Fed raises the interest rates, they're not going to have any room to still lower it during a recession.
Wait. Explain that.
All right, so interest rates are only high, the federal interest rates are only high relative to an equilibrium point. It doesn't matter how high they raise them, it doesn't change the fact that like there's lower.
You're not explaining anything. You just
say
equilibrium point means that you can't predict interest rates.
The reason they lower it during a recession is to like create stimulus in the economy.
Yeah.
It only stimulates things when it's below the equilibrium point. So raising the interest rate doesn't, because that's just how the economy works. It's only
what you can't just say that's just how the economy works and then not explain it. I would contend that the Fed can lower interest rates because that means injecting money in the economy.
Sure.
The more money the Fed has, the more it can inject in the economy, and that is how we solve for recessions.
Great.
So let's talk about your first contention on bubbles, right?
Yep.
Can you tell me the exact definition of speculation?
It's when you inflate stock prices because you're just speculating about its value.
It's short-term risky investments where an investor buys a stock then immediately sells it.
Just going to be down your case. Is everybody ready? Start on their first point, where they tell you you're going to increase stock valuations. Two responses on the link level. First, Jen of Queen's University explains in 2015 that the capital gains tax has minimal effect on preventing overvaluation because the benefits of being able to mitigate losses that decreases the risk of speculatory investments balances out the mitigation of gains that some say incentivizes risky economic behavior. Because right now, when you lose money from speculation, you can deduct that from your income taxes. But if we can get rid of the capital gains tax, that goes away, which means there's no net effect on speculation. But second, they tell you that there's going to be a massive overvaluation, but I would argue that there's going to be less valuation because of a sell-off that happens. We tell you in their second contention that a lot of assets that are locked in will not be locked in anymore, so investors will sell other stocks, which decreases the amount of the pricing in the stock market. Ultimately, this is a turn on their first contention because you're going to see a decrease in prices, which ultimately prevents bubbles from being as large. But now, 4 reasons on why getting rid of the capital gains tax makes bubbles smaller. First, Amadeo the Balance finds that low interest rates are the biggest contributors to bubbles because people borrow too much to contribute to the bubble. Affirming their resolution, as they say themselves, is going to increase the interest rates, which decreases the number of people joining the bubble. Right now, the bubble is not at critical mass, but if you allow the status quo to continue, the bubble will grow to critical mass and crash the economy. But second, affirming makes bubbles less dangerous. The Collaborative Fund explains that bubbles cause huge economic damage because long-term investors hop onto bubbles when they grow over a long period of time. These investors cause the bubble to impact the overall economy. If the bubble is only held by short-term speculators because all the long-term investors are too afraid to take the risk, then you're going to see a bubble being less dangerous. But third, long-term investors are the reason why bubbles grow so large, because when short-term investors speculate, the price fluctuates up and down. But when long-term investors join the bubble, they never leave the bubble, which means the price will only go up. That's why when you have more speculation, the price just goes up and down. You don't see an increase in long-term investors backing the value of the bubble. That's why you're going to see bubbles being less dangerous. But fourth, cross-apply our third contention, where you tell you that getting rid of the capital gains tax increases the amount of shorting investors do. Shorting happens when investors believe an asset is overvalued and will likely go down, which is literally the stock market right now and asset markets. But what the reason why they're not shorting right now is because the profit is far too small. The capital gains tax taxes short-term profits much higher than long-term profits, and shorting is a really, really short-term investment. So what happens is when people try to make money off shorting now, the fees that they have to pay for shorting on like borrowing the stock is far too high, so they never make any money. But when you affirm the resolution, there's no tax on shorting, so shorters will ultimately make the bubbles go smaller. You're not going to see a crash in the economy. But now onto the second point on overheating. Recognize that 1, they don't say how much the economy gets stimulated by, and 2, they don't say why the economy even gets stimulated more. I would argue that the only thing that happens is the Fed increases interest rates because they think the economy is going to be stimulated more. And third, they literally just compare all this to the Trump tax bill, but the Trump tax bill put trillions of dollars into the economy. This is just the decrease in the capital gains tax, which doesn't impact the overall economy as much. But 4 more responses. First, Berman in the Washington Post finds that high prices and inflation doesn't mean we're at full economic capacity. There's a difference between heating and overheating. Cutting the capital gains tax just means a little bit of heating occurs. But second, Applebaum in the New York Times finds that in order to avoid overheating, the Fed will just raise interest rates more quickly. The more growth is stimulated, the faster interest rates happen. They say that like the Fed is going to screw up and cause a recession, but the Fed is already considering raising interest rates 4 times this year. 4 times this year. They don't tell you like why that doesn't screw up and cause a recession, and like why our increase will. And finally, the Higher Washington Education finds that automatic stabilizers also slow down our economy's growth rate during overheated periods when incomes are rising. The added income pushes taxpayers to a higher tax rate, which increases the taxpayer's bill, which ultimately decreases the money in the economy. And finally, they tell you there's a lot of jobs that aren't being taken, but the reason why those jobs aren't being taken is because of lack of skill, not because there's too many jobs and not enough people, not enough workers.
All right, we're going to take some prep starting now.
We're gonna start with, can I see Cherry, second card from your case? Cherry, maybe? Increase in managers by 1%.
Here and just go up.
Go to them.
You guys good? All 3 judges? Alright, it's going to start on R sub B. Brandon, at the end of his own rebuttal, tells you that right now the Fed is planning on increasing interest rates. That's really important, because if right now the Fed is planning on increasing interest rates, that literally non-uniques the entirety of his second contention, which says that when the Fed increases interest rates, this solves the problem. If the Fed is increasing interest rates right now, that's solving the problem. Which means that literally all his contention is telling you is that when we do this, when we overheat the economy, and when we increase inflation, then the Fed has to raise them faster. That's important because what Lockman tells you is that the chance that the Fed increases the interest rate too fast and via that mechanism causes a contraction is really high, which means that the faster that the Fed increases interest rates, the higher the probability that this miscalculation occurs. Which means that the comparison between the two worlds is not whether or not the Fed increases interest rates. It's how fast the Fed increases interest rates, and we tell you in their world they do it faster, which just increases the probability of a miscalculation. They don't have offense on their second contention at this point, just by that concession. With that said, go to their case. On this idea of managers, if you scroll up the paragraph above this increase in managers, 29%, literally the rhetoric the author uses is managers drive their businesses into the ground when they don't sell to larger corporations. That's important because if there's an increase in managers, because people think it's more in their financial interest to hold on to their businesses instead of selling them off to larger corporations, then there's an increase in entrepreneurs failing. That is what his own evidence says. You can call it if you don't believe me. Also, there really isn't a comparative reason why we would see this large hike in managers, because even if I go to a large firm, if I'm a high-level management, a lot of my salary is paid to me in things like stock options, which means that independent of whether I go to a small business or a large business, it's the same thing. They don't give you real warrant as to why this would increase. On this idea of monetary policy, remember, he just told you they're increasing interest rates anyway. It doesn't really matter. But then go to his first impact where he talks about debt. Here's the really big problem. The reason that right now they're taking out all of these loans is because these loans are easier to pay back, which means that when I take this loan, even if I'm taking more loans, the probability that I default on my loan decreases substantially. That's important because when he then goes on to do his analysis about how there's an increase in loans causes an increase in the probability of recession, that isn't accounting for the fact that the loans are easier to pay off, which means there's two warrants. And this is important because the fact that this decrease is occurring is the reason that they're taking out the loans, means that these corporations think it is in their own financial incentive to be taking out these loans, which means they're probably higher, better quality and less likely to be defaulted on, which is the terminal impact on this point. Go to this idea of relief, a few problems. Alpha at the bottom of our case tells you that the current financial trap that our country is going on is sustainable. That is really important because even if his evidence tells you that there's a 60% chance that this happens in 4 years, remember that's long term. 4 years. The Fed has plenty of time, which means that he's telling you that right now, independent of how fast the Fed increases interest rates, it doesn't matter. They just have to increase them. He's telling you that happens in both worlds. We tell you that you just get the unique harm of risking some type of economic catastrophe when the Fed increases them too fast, which is really the only unique impact at this point. Go to the bottom where he talks about shorting. Here's the really big problem. Fisher tells you on this idea of shorting that what we've actually seen historically when we've cut capital gains taxes, sometimes it boosts the stock market, and sometimes it causes the stock market to fall, because all that really matters is the status quo in terms of the economic reality. What that also indicates is that you're never going to actually get rid of the bubble. The only thing that you're going to do is comparatively increase or decrease the ceiling or height to which it can get to. That's important because what our husband analysis in our case tells you is that when you decrease the price of these stocks, all we see is investors get, oh, great, I'm making more money because this tax has gone away, and then just dump more money in, become impressed with their own speculation, which means on net, we just see the ceiling increase, these bubbles get worse.
Wait, before I will, call. Oh yeah.
How's your loss been calculated?
Which part of it?
The entire
The miscalculation.
Yeah.
Specifically.
Is everybody ready? You guys ready?
Yeah.
Okay. So the Fed's increasing interest rates right now. What's to stop them from miscalculating?
Well, we would say that the faster they increase it, the higher the probability that this
Wait, why?
goes into a catastrophe. Because
And
essentially,
also, why does it cause?
You want me to explain?
Yeah. Go ahead.
Okay, if the Fed increases interest rates too fast, the economy can't respond fast enough.
What does that mean?
I mean, well, you can explain it in summary, but essentially what happens is if I increase the interest rate really, really fast, right, then everybody who's used to all of this really low interest rate
Okay.
and all the outstanding debt, etc., sort of gets messed up. Can I ask you a
Why
question?
does the outstanding debt get messed up? The outstanding debt is all,
No,
is
it's not even
all
a
at
question.
a lower
okay,
interest rate.
Brandon, it's not a question of the outstanding debt.
You literally just
No.
said it was.
It is in the sense that if I'm like a corporation, right, who's going through my planning in terms of what I'm going to do in the future, right, this is the basis or the interest rate that I'm planning on employing. And on top of that,
So if the Fed says
But-
we're going to
okay.
raise interest rates,
also
doesn't
things like
that
the
mean
stock market, no, because
corporations
things like the
plan for
stock
that?
market and other markets also respond with respect to the interest rate,
Okay.
right? They calculate that into their prices,
So what's
which
the
means if
problem?
you change the interest rate really fast, that also changes those markets really fast and creates
That's
high
not how it
volatility.
works. When the Fed raises
Why
interest
is that not
rates,
how it
they
works?
announce they're going to raise interest rates by this
Right.
amount in the future.
See, that announcement does things like mess with the stock market. If they say, we're going to raise it really fast, then that would have an even greater effect.
Wait, you just said the reason why the stock market gets messed up is because people don't know what the Fed does.
No, they don't know what the Fed does. They don't know that the Fed is going to announce to do it until the Fed announces to do
So
it.
the Fed announces they're going to raise interest rates later. Why does that matter? The stock market has months to correct itself.
No, it doesn't, because it corrects fast, Brandon. If all this
Wait,
information
if
comes
it
in,
corrects
no,
fast,
it-
then what's the problem?
Because it crashes. Can I ask you a question?
Wait,
You've been
why does
asking
it
me about
crash?
for like 140.
You're not giving me any warranty.
I'm giving you warranting.
No, you're not.
You don't give warranting in your case. Can I ask you a question, please?
I gave you 4 minutes of words. Go ahead.
All right. Let's talk about this idea of increasing the interest rate. If the interest rate is increasing anyway, then how do any of your impacts trigger?
Because right now the Fed is increasing interest rate by 0.75% this year. That's not enough. Do I have a question?
Why is that not enough?
It's not enough because at any time within the next 4 years we can
How
have
much
a
is
recession. Enough is near like 5%, which when a recession happens, we can lower it to near zero to solve back for the problem.
Why does the chronological comparative matter?
Why? What?
You telling me in your case that because interest rates are so low, capital is cheap right now. Why does it need to be high and then we make it low? Why can't we just keep it low?
Oh, because when you lower interest rates, it puts stimulus of the economy.
Right, because it makes capital more accessible, but you're telling me capital is accessible now. So why does the chronological comparison matter?
Because if capital is accessible now and a recession happens, capital isn't accessible anymore. So when you lower the interest
Why?
rate, it's accessible.
Right,
Because a
but
recession
you literally your
decreases
dead
aggregate
warrant is
demand.
that capital is too accessible right now.
Recessions is a decrease in aggregate demand, meaning there's a decrease in
Brandon,
demand for investment.
Brandon, your own
There's
case
less
tells me that capital is cheap right now, which is why
Yeah, it's
all
cheap
these
right
corporations
now.
are taking.
But if you have a recession, it's not cheap anymore.
Why?
So you need to make it cheap
It's
later.
still low.
Because there's a decrease in aggregate demand, which means a decrease in investors willing to invest and decrease in the amount of investment.
Why do investors
opportunities.
care what the
That's not.
interest rate used to be? That's what I don't
They
understand.
care when a recession happens.
What
I would like to see Lockman.
Yeah.
Two cards. Here's both that we say that presidents will draw.
Oh yeah, can we see the PDF? Or like the actual source?
See the other one not included, but
What's the other one?
it says something similar. Pretty much it says like the
No, it's fine. Alright, we'll take both next week.
Alright, so for clarity, the order of my speech, it's going to start off in this Lockman miscalculation thing, that it's going to go on to just offense, and how we win. Is everyone ready? let's start with this Lockman miscalculation thing. We call their card two major problems with this. First, their card never actually explicitly says that when you increase interest rates too fast, you see a recession. That card is completely misconstrued. Second, that card says we should have already seen this recession happen last week when the Fed raised interest rates. A recession didn't happen. The card is wrong. But then let's go on to how we win this round. We're going to win on bubbles. But the way we win is we link into bubbles in three ways. First, they try to say that increased interest rates is non-unique because the Fed's already doing it right now. But to recognize that the Fed's only increasing it by 0.75% this year, we needed to increase more. We do that by unleashing $5 trillion into the economy, which increases inflation, which forces the increase of interest rates. That's really important because what you find is that increasing interest rates decreases the chances that a bubble form because lower interest rates cause people to use more money and leveraging to pour that money into assets, which increases the overvaluation of these assets, which causes these bubbles, which when they crash the economy. The second way we link into bubbles is less long-term investment and more speculation. They try to link into speculation, increasing bubbles and causing this huge crisis. But recognize that speculation is much better suited than the alternative because the alternative is long-term investment. But long-term investment is when investors that keep on shoving money into assets for years on end, which completely overinflates these assets for a long periods of time. Speculation is when investors put money into these assets and then immediately sell these assets, making the price fluctuate, meaning the asset never actually becomes overvalued because it keeps on just going up and down, meaning you don't see bubbles in our world, you see more bubbles in their world. The third way we link into bubbles is through shorting. Recognize that shorting deflates bubbles because when people use it, it signifies to other investors that an asset is overvalued, deterring investment into these assets, preventing it from becoming further inflated. That's really important because the capital gains tax severely disincentivizes shorting by taxing the profit on shorts in the short term, forcing investors not to actually do shorting until later on when the bubble is too big. They try to respond by saying that historically, whenever you see capital gains tax cuts, the stock market goes up and down. I don't understand how this is a response to or how it actually interacts with our argument. And B, recognize that a bright line for our impact is getting rid of the tax immediately because that's when you actually provide the incentive in order for investors to do this in the short term rather than the long term.
All right, we're going to run prep starting now. Seconds, we have 5 remaining. Alright, I'm gonna start on their third contention. Is everybody ready? In his summary, he says the really good thing about cutting the capital gains tax right now is they pop the bubbles. That's really critical. If they don't respond to Lockman at the top of our case, then now is the absolute worst time to have a recession. The reason being so is because there are bubbles in literally every part of the market, in literally every country in the world. Right now, if you pop the bubbles, it will cause a massive global catastrophe. That's really problematic for their case for a couple of reasons. The biggest one being so is when you see a global catastrophe at that level, it destroys established fiscal monetary policy to the point where literally none of their links are probably going to be true in the long term, but like making it better respond to recession, all those things. Because there's such a big catastrophe, it literally just resets the entire economy. None of their stuff matters in the long term because they started the catastrophe. That's going to be really critical. It doesn't happen in our world because of the seeking alpha card at the bottom of our case that they didn't respond to. They tell you right now there's a lot of good indicators in the economy that despite the overheating, we're not seeing this they're not seeing that this crash is going to happen unless we see more stimulus. They try to respond by saying, oh, how much stimulus? They literally say in their case it is $5 trillion of stimulus. We tell you that is enough to push us over the edge. Next they say, oh, it's not really like, it's not the jobs problem, it's really like jobs, it's like lack of skill. The economist in our case literally tells you in our sub-point B that right now we're creating 170,000 jobs and only 50,000 people are entering the job market. That's not lack of skill, that's literally lack of people. We are overheating. Then they say there's automatic stabilizers. Seeking alpha says those automatic stabilizers are what's saving right now, but we can simply push over the edge by more overheating. They don't respond to that. Then they say this whole idea of how in the context of like the tax bill, it doesn't matter. We tell you adding $5 trillion more puts us over the edge, that's still seeking alpha. Now, that's really critical because long-term what we're telling you, we're seeing this giant catastrophe, they're not really seeing anything happening, they don't really respond to that. But even then, let's look at their, But then even on our first contention, they spend a lot of time saying how they're going to prevent bubbles because they're talking all about speculation. Here's the really big problem with that is, like, they just say, oh, speculation is good and assume so because it doesn't create bubbles. They don't respond to the warranting of Husband. Husband tells you that speculators aren't very rational. When they speculate, they see the spot prices jump briefly and they think, oh, I can speculate more and more and more. Even if they're selling and buying quickly short term, does not mean the prices still go up. It means we're still creating more bubbles in their world. They don't really respond to the Husband warranting at all. That's really critical because even if they theoretically solve more bubbles, long term they're still creating more bubbles through Husband. They cold drop that, they're just making the problem worse. In the long term, they're just popping the global financial bubble, resetting all monetary policy. None of their impacts matter. At the point you can clearly vote for us.
Alright, we're ready for Grand Cross. Alright, you guys ready?
Yep.
Alright, so let's start off on this idea of speculation. Speculation is when an investor invests in an asset and sells it, correct?
Yeah.
After a short-term increase.
Yes.
So what does that mean with increased speculation? We just see the asset price go up and down and up
No,
and down.
because Husband tells you that like these short-term investors aren't actually rational, and they basically just egotistically.
They just keep on pumping
What's their
more and making more and more short-term investments
So-
until they add up and
Wait,
climb.
why does the
Wait,
rationality of these investors have to do with when you increase demand for something, the price goes up, and when you decrease demand for something, the price goes
Because
down?
because people are constantly speculating to the point where, like, just
Yeah,
because
so
they're
it
selling,
keeps on going up and down.
they're selling but they're buying more
If
at
I'm
the
a
same
short-term
time.
speculator, can I leverage?
What? What do you mean?
Can I leverage my money if I'm a short-term
Yeah,
speculator?
yeah.
Yeah, so I'm so convinced that I'm speculating correctly
So
that I just keep
here-
pumping more
okay.
and more money in the form of leveraging.
So then you sell it.
Then it increases.
Okay, make
You
money.
sell
Yeah,
it,
you sell
you
it.
sell it, but
Whole
someone
lot
else
of
buys and it still
You
goes
make
up.
Yeah,
profit
yeah,
when you sell
okay.
things, right?
So
Yeah,
yeah,
so I buy
we
it and I sell
agree,
it, and then somebody else is buying it and then selling it, and
we
more and more
agree
money
that
in
it's
the
like
form of
And
almost
ladders
the
up.
same. We agree
You
that
sell it at a higher
speculation
price,
keeps on going
and
up.
sells at a
But
higher
you
price.
see, when more speculators buy, they immediately sell.
Wait,
Meaning the asset price immediately goes
when,
down.
when you sell, what happens? Are you selling because it's high or low?
You
Sell much
Right.
high.
So you're
it
selling
goes
that
down.
high to another speculator who then brings the asset higher and
no.
sells it
when
when
you
it's high
sell it
again.
high, when you sell it high, A, more supply, and B, decreased
No,
demand.
we tell you
That's why
because there's
selling
so much
decreases
speculation,
the
we don't
price.
see drop in supply. We just see continuous uptake.
No, it's not how it works.
Okay, ready?
Speculation, by definition, means that someone needs to
this-
sell at the end of it, meaning it just keeps on going up and down
wait.
and up and
How
down.
does a Ponzi scheme work?
No, I don't know. You tell me.
Person A, it's very comparable. Let's say to simplify things, I had a two-person stock market. Person one buys it, the stock price increases, so then they sell to person two. Person two, because they just sold it,
But when they sell it to person two, the
There's
price
no
goes
reason
down.
this is
The thing is,
unsustainable.
the stock market doesn't have two people, and so,
Right, so when you increase the
it
number of
doesn't
people,
work
it's
like
because of
that.
why?
Because when you have these speculators, they want to buy low and sell high. So if you want to, so when one
Right, and then
speculator
it
wants to
just
sell
increases,
high,
they think it's gonna increase
in order to
more.
sell it for to another guy who wants to buy
But
low,
they think the
they
high
have
is
to
the new
decrease
low.
the price.
Brandon, that's what you're misunderstanding. They think the high
That's
is
what
the new
that's what
low.
the
But
husband,
the
they're not
problem is
rational.
when
really
they
critical.
sell it to the other speculator, the
The
asset
speculator
goes
thinks
back down.
the
to the original
speculator
price.
thinks the high is the new low,
The
and it goes
speculator-
up more.
Even if your
It doesn't
analysis
matter.
is true, you're still not responding to investors who short.
Brandon, the speculation and shorting.
Shorting
we do
is
respond to
speculating
shorting.
the opposite direction.
No, here's the thing.
Right now,
We can-
speculation only goes
Brandon,
upwards.
We concede shorting.
Okay.
And then we say that if shorting is
then
true,
it's game over.
Then it pops all the
Yeah,
global,
for you, it's
then
game
it
over.
pops
It's
all the
game over
global
in Grand
asset
Cross.
prices
I don't
and
even
the
have to say
global
this in front of
economic
you.
Armageddon.
Yeah.
Because you cold drop lock on the top of our case, that now is the worst
Don't
possible
full
time.
drop lock.
No,
I say two index at the top of my summary.
No. You respond to the lock-in part about like the interest rates in general. Lock-in tells you in general the entire world is in a very precarious situation
All right.
because there's asset bubbles literally everywhere.
So if you- when you pop the
when
bubbles,
you
you have
say
big problems,
word for
right?
word, we pop the bubble, we need global financial Armageddon.
We're
That's fine.
deflating the bubble. We'll take the rest
Yes,
of
you're
it.
pumping it. That is literally what you call it in your case.
Is everybody ready? Like I said in Grand Cross, it's game over for them because we win on strength of link to recessions. We do this because we give you 3 ways we solve bubble formation. And bubbles are caused of the recession because when they burst, they destroy $6 trillion of household wealth and cause the 2008 recession. The first way is through interest rates. We tell you when we put more money into the economy, the Fed is going to increase interest rates. When the Fed increases interest rates, less people are willing to leverage, less people are borrowing and putting their money into assets. They're going to come up here and say increased interest rates is bad. But the thing is that when the Fed signaled that they increased interest rates by 0.75% this year, we had 1 week of stock market corrections. If the Fed says they're going to increase interest rates more, you're going to see like a week of stock market correction, which has no impact whatsoever. But second is on speculation. We tell you that when you increase short-term speculation, long-term investors will never invest in asset bubbles. The reason why asset bubbles are so bad is because long-term investors are putting their money into these asset bubbles, and when they pop, you see big impacts on the rest of the economy. When short-term investors are investing in the bubble, you're only going to see rates, the prices go up and down. They're not being supported by long-term investments who keep their money in there and never sell. That's why you're decreasing the chance of a bubble formation. But third is on shorting. They literally concede shorting. What shorting does is when right now there's no shorting on bubbles, so bubbles are able to grow and grow. But what shorting does is that signals that the asset is overvalued and that is a bubble. So people are going to decrease their purchasing and increase the shorting of the bubble. That's really critical because you're deflating the bubble. They're going to come up here and say you pop the bubble, but bubbles only pop when they reach critical mass. Right now we have a lot of bubbles, but shorting is going to be the reason why we solve, because you're signaling that it's overvalued, the prices will ultimately go down. That's why with these 3 links, we're winning the link to recession, decreasing the amount of people going to poverty. But the last thing they can go for is by saying the economy overheats. But they never respond to the fact the Fed is just going to raise interest rates. Interest rates would solve for the overheating. They're going to say interest rates raising it bad, but you only see a week of corrections. They have no impacts, and we have impacts.
All right, we're on our last one.
Everybody good? Brandon starts his final focus by saying it's game over, you vote for them. We would contend it's the opposite. If you vote for them, it's game over for the global economy. Because they never respond to Lockman, who tells you that right now is a uniquely bad time to be doing this. Literally their warning story throughout this entire round has been that you pop the bubbles before they've been created. But they never respond to Lockman, who tells you that the bubbles have already been created on a large macroeconomic, intercontinental, global level, which is why if we see this recession, it literally triggers everywhere and leads to economic catastrophe. This is literally never responded to in any way whatsoever throughout the entirety of this round, which means that independent of how impressed you are with Brandon's understanding of market speculation and short-term trends, it literally doesn't matter because we never get to that point, because as soon as you vote for them, we see the economic recession trigger. Never touched on by my opponents. Easiest place to be voting for us. Particularly because they also really never respond to Seeking Alpha at the bottom of our case, who says that the current economic track is completely sustainable. Now, even if you think that there is a 60% chance that this economic recession gets triggered in 4 years, fine, the recession gets triggered. But if the recession gets triggered right now, it is a uniquely bad, which means that this is a unique offense for us and a reason to be voting for us. None of their short-term trends matter, and none of them hold over into the long term, because what James tells you in summary, that is, when we see this recession hit, monetary and fiscal policy always get overturned, which means that none of his links through monetary or fiscal policy matter, because literally everything gets reset. None of these links hold into the long term because we hit the recession first. Literally all that this round comes down to is a question of time. Their impacts don't have the time to materialize because you see the Armageddon, because you see the financial catastrophe. They never really ever respond to this, which is why it's the easiest place to be voting for us.
Okay.